what these weekend podcasts are about is to show you what really works in investing. And there is an incredible amount of noise out there in the world for everything, mostly because of the internet. And investing is not immune to it. In fact, it's probably even worse. And so there's just so much information out there, so much noise. And early on in my 20s, I found price charts and I studied price. And I found that if you can study price, you can eliminate a significant amount of the noise. And so each week, what I want to do is show you what I'm seeing. What is of most interest to me? What price charts are moving up or down or sideways, and what's of most noteworthiness that I want to spend 10 or 15 minutes with you every weekend to show you what I'm seeing. And in that, it's not just to point out what I'm seeing, but also what to do with your money. Now, in here, I don't necessarily tell you specifically how this all gets down to what to do with your money. I do that in my membership, where I show you specifically what to do. And I have 3 specific strategies that I have built out. But here I want to talk about really kind of the biggest takeaway from the week within investing. Now, my theme this week, I had to think about it a little bit. Actually, I didn't have to think about what to talk about, but I had to think about what to call it. And as I speak to you now, I have my daughter in the other room playing. It was her last day of preschool, so you may hear some noise in the background. That's my daughter. And let's get into this. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend is, and not a 30-second. That's quite a theme, and not a 30-second. So, ... and not a 30-second year. Now, the price chart I'm showing you here is the yield of the 10-year Treasury, the 10-year U.S. Treasury, from 1981 till today. And back in 1981, you could give the U.S. government your money for 10 years, and they would give you about 16% a year. And since 1981, that yield has been falling and falling and falling until it fell all the way down to about 1.32% back in June of 2012. That's amazing. So in June of 2012, if you gave the U.S. government your money for 10 years, they would have given you, they said, great, you give me your money, and every year I'm going to give you 1.32% on your money, plus you'll get your money back in 10 years. Pretty amazing. Even outside of Silicon Valley, I'm sure the inflation rate was north of 1.3% back in June of 2012. But since June of 2012, the 10-year has been going up, and today it's about 2.4%. Now, this price chart has 3 lines on it. One is the squiggly line, which is the actual yield of the 10-year Treasury. Then you got the red, less squiggly line, and that is a 200-week moving average. So that is the average of every 200 weeks put into a point, a price. And then that black really, it's almost like on a 45-degree angle. That's a linear regression line. So basically, what's the mean? What's the average of this line from 81 to today? To today, and you can see that's maybe not quite a 45-degree angle, but rates have been falling. So for someone to say they've absolutely fallen, we're still in a very big picture or long-term point of view. We're still in a situation, an environment where rates are falling. But the question is, did they stop falling in June of 2012? Did they stop falling 3 years ago? And we won't know that yet, but they definitely stopped falling 3 years ago on a shorter term. So let's talk about what that means. Now, it means some things are going to do really well, some sectors are going to do really well, and some sectors aren't going to do well. So one of them that will do well, and I talked about this last week, is regional banks. Regional banks have basically been going sideways for 2 years-ish in a kind of a volatile sidewaysness, and they broke out. Now, they tried to break out back in February of last year, 2014, but they had what's called a false breakout. But generally speaking, they've been going sideways. Yet, if you look at that 200-day moving average, which is the red line, you can see even through the sidewaysness, the 200-day moving average was moving higher. So what's nice about the 200-day is it really gives you that big picture, even when something's going sideways, what's kind of the the general major direction of it. And even through the sideways movement of regional banks, we still had the 200-day moving higher. And you can see with my big circle over on the upper right, not only has it broken out, but it is breaking out to the upside even more. Talked about this last week. It is clearly moving higher. So regional banks see higher interest rates. Insurance companies see higher interest rates coming. Brokerage companies like Schwab and TD Ameritrade, they see higher rates coming too. So you have three major sectors seeing higher rates. And if you look at the financial sector, you'll also see that that sector is starting to do much better than the overall market. I just wanted to show you one sector and not inundate you with too many price charts. On the flip side of this is what goes down, what sector goes down when yields start to increase? And the answer is utilities. If you look at this price chart, you can see the 200-day moving average, which is the red, less squiggly line than the black, but the red line. You can see how it's kind of flatlined since March of this year. And it's really flat, slightly down, but you can see the price itself is breaking down. So utilities, people typically get into utilities to get yield, but with interest rates potentially going higher, well, first of all, they are going higher, and with the Federal Reserve potentially increasing their federal funds rate for the first time this year, certain sectors are saying, yes, this is happening. So the question is, one of the questions, it affects sectors, and one of my strategies has to do with whether you should own gold or not own gold and how to own gold. And so one of the questions is, how is this going to affect gold? Well, here's a price chart. This is a price chart comparing the yield of the 10-year Treasury on the price of gold. Now, the blue line is the yield, and the kind of the burnt orange line is gold. And this goes back to June of 2012. So let's call it a 3-year chart. Well, interest rates, 10-year yield is up 64%, and gold during the same time period is down 29%. Now, it doesn't mean every time yields go up, gold goes down, but that's what's happening right now. And the most important data we have is the data we have right now with the most current situation. June of 2012 to today is the most recent 3-year period, and gold is not liking, let's call it the stabilization of interest rates and the increase of rates. Now, will this continue forever? And if the 10-year Treasury spends the next 35 years going higher, does gold spend the next 35 years going lower? And the answer, I think, is no. I shouldn't say I think. The history says not the case, but right now it is the case. Now, if we zoom in a little bit on this price chart, and I just show you what's been going on since the beginning, near the beginning of this year, we have the 10-year Treasury higher and we have gold lower. And this is from February 5th to June 5th. So we have basically the last 5 months of what's going on. So this trend is continuing. And as the yield goes up, gold hasn't fully broken down to new lows. And I'm not predicting it's going to fall to new lows immediately. But really the question for gold is, can it hold above 1140? If you look at the price chart here going back to July of 2013, so let's just call it 2-ish years, gold's falling. The red line on the screen is the 200-day moving average. It is falling. Again, the 200-day is just a nice, easy way to tell you the general direction of something you're looking at. And then the black line is the price of gold. Now this price chart's actually GLD. So what we have is we have a price of about $1,140 that gold hit in November of last year, hit it again in November of last year, then hit it in March twice, and now here we are potentially hitting it for the 5th time. The question I have is, do the buyers come in again? Do people come in again and buy gold and stop the fall at 1140? Or are they going to step aside, or are people going to throw in the towel? Now look, I think gold has a very good future. The last 3.5 years has not been good for it. Silver even worse. Silver peaked 4 years ago. It's actually 4 years and a month ago. So silver is even in worse shape. But as of right now, gold is going down. Its big picture clearly shows the price is falling. And so we want to step aside and wait for that trend to really be behind us, that momentum to be behind us. And I'm not saying it's easy. I'm not saying it's a casual decision you should make, especially if you were in gold or had only gotten into gold since September of 2011. All you know is gold falls. Now, if you were in gold before September of 2011, depending on when you got into it, you had a pretty good run up. But right now, it is absolutely in a major correction phase, looking for a bottom, and we'll have to see what happens at 1140. Based on what happens there, if it falls below 1140, then really the next major support is about $1,000, and the next major support below $1,000 is 850. I'm not saying it's going to go to those two, but those are going to be the two next places it wants to go. If it does hit $1,000, then the question would be, is it going to have just one final clean out to 850? Though from 1,000 to 850 is only 15%. I put only quotes around that word only, but in the near future, and I don't want to define what that is, I actually see gold solving all the silliness of the World Banks that they've been doing the last, what do we call that, since 2008-ish, kind of ruining all the currencies of the world. So the question is, what's the takeaway? And what can you take away from this? Well, the first thing is gold does have a future. You want the momentum to be behind you. There's no bonus points in sitting through the pain. I've adjusted my strategy to gold. I still think it's a great long-term investment, but I want to wait for the momentum to be behind us and for the price to start moving up again. So short term, it's looking for a bottom. Is it going to be 1140? We'll have to wait and see. Is it going to be 1,000? If it is, we'll look at that. We'll talk about what to invest in then. Most likely, it's not just going to, if it does break 1140, it won't just go from 1140 to 1,000. Though if it did, that would be in some ways very nice, a very painful clean out, and a potential great buying opportunity. Long term, I actually think gold's going to be the savior. I think it's going to be the savior of the planet. Just the silliness of central bankers. They've done it before. This is not the first time they've manipulated and hurt the markets. Of course they manipulate, because manipulation always works at the beginning. That's why they do it, because it works at the beginning. What to do with this information, how to integrate it into your portfolio, into your investments, into your net worth. That's what we do inside the Fearless Wealth Club. I give you a monthly conversation. You get to ask me any questions you want. We look at our strategies. You get all the tools I've ever created. That's actually something new. I'm giving away all the tools that I've ever created, all the trainings, all the reports. But that's where really I've noticed the biggest want for what I call outlier investors has been, which is I just want to know what to do. I don't want it to be complicated. Just tell me, show me why, give me the evidence, and make it straightforward. I think that's what happens, or what's missing a lot with others. Hey guys, I'm so glad you're here. I want you to have a great weekend. Really, I want you to think about this as just really another step. So if you don't have any exposure to gold, that's fine. You may have some in the future. If you do, this is just what I see happening right now. Just really another step in helping you secure your portfolio and secure your future. Until next time, this is RC Peck.